Testing, testing. All right. Good evening, everyone. Okay. I hope you guys can hear me. All right. Okay. Tonight is our first quarter market outlook for the year 2025. My name is Elki, and thank you for you guys to come here. I'm not sure if Johor is jam or not, but if in KL right now it's like wow, the jam is like terrible. Okay. But thank you for you guys, your making effort to be here tonight. And today our event we are running both online and offsite together. Okay, yeah. So we might have some questions from our social media, YouTube and Facebook, and we also will have some questions from the on-site here at our JB branch. All right. Okay. Yeah. So today we will start with from our head of research to share their insights on the markets from the global and the local, followed by our research team on their stocks coverage, and the last but not least will be from my side on the technical. Okay, yeah. So without further ado, I will pass the floor to Victor.
All right. Thank you very much. Good evening, everyone. I apologize for the delay. We had a little bit of a technical issue, but nevertheless, that has been resolved right now. So I think we shall dive straight into the presentation proper. So my name is Victor. I'm the head of research of Inter-Pacific Research Sdn Bhd. So my presentation, I will start off with the economic and market updates. Then my colleagues will provide you with the updates on some of the companies' stocks that we cover. And then, of course, Elki will end with the technical side of things. All right. So, okay. Looking at the title, you can see that things are looking very volatile. Okay. And I think that is going to be the theme for the rest of the quarter. So I will explain why I think the volatility will persist as we move along. Okay. But moving on, just a quick disclaimer here. And then moving on to the topic of my talk. Okay, so I'll start off first with a very quick review of the Malaysian and global economic conditions. Then we'll look at the economic outlook, and then we'll look at the market review. What has happened in the fourth quarter, and of course in 2024 as well. And of course we'll end with the market outlook on my side. All right. So very quickly, if you look at the global economic conditions in third quarter of last year, that was the latest one we had. You can see that the conditions are very mixed. All right. Although there is still growth in most of the selected countries that you see on your screen and on the slides, right? So first half of the year was certainly very strong for most global markets, global economies, but tapered slightly in the third quarter of the year. Looking at individual regions and countries, you can see that the US was still the big performer globally because of a strong pickup in retail spending as interest rates continue to wane. So in fact, Europe has also posted slightly stronger growth, mainly because of reduced interest rates, and of course that cushioned its economy from the slower external environment. However, if you look at just the two main output sectors, in other words, here the global manufacturing and the services industry, these are the PMIs of individual countries. You can see that looking at the 50 line, where you can see that the manufacturing sector has been very much in contraction for the most part of the year and continues to do so. But having said that, the services side is continuing to post very strong growth, so it's above 50. Of course, if you look at it, the contraction in the manufacturing side is mainly from Europe and the US side, especially if you look at France and in Germany. Their industrial production, the industrial output is very weak due to slow external demand. All right. So even with the continued growth that we saw in the first slide, you can see that the US economy grew at a rate that was below expectation in the third quarter. And as I said earlier, it's supported mainly by consumer spending. And of course, on top of that is also backed by very strong employment, continuing wage growth, and of course, easing inflation. Strong government spending also helped the US economy to offset its slower net exports. Employment remains steady at around 4%, with wage growth also seeing very strong growth at about 4% over the past 12 months. Whereas growth among European economies, there was some growth offset by sluggish manufacturing output due to low demand. And of course, with Germany, the most affected country due to low external demand. As a whole, if you look at Asia, yes, very strong growth, but it was slightly slower than what was recorded in the second quarter of this year, mainly due to backed actually very much by strong domestic activities and investments to offset the slower export market. As you know, Asian economies are very dependent on exports of goods. So there is a reduced demand for goods, and that's the reason why we saw slower growth. This is particularly so for China. But having said that, China's economy was supported by its domestic spending. Whereas if you look at Japan, GDP was actually helped by increase in investments and exports. Right. Moving on to the Malaysian side, very positive numbers in the third quarter of the year, even though it was lower than what was recorded in the second quarter of this year. Growth was at 5.3%, very much, again, helped by investment activities, a lot of it on the data centers, increasing household spending, and then, of course, improvements in export activities. And there's also a surge in in tourism activities. So another factor that actually helped the Malaysian economy to post fairly strong growth is basically the manageable headline inflation that has come off quite a bit. And of course, that has also fueled domestic spending appetite. The employment was very strong. The unemployment rate continues to edge lower to just above 3% in the third quarter of this year. And it's also supported by a decent wage growth in the third quarter of the year. So looking at the numbers, you can see that sectorially, the construction sector was the biggest gainer of about 20%. And that is, of course, a lot of it is actually due to the construction of data centers. That has been the big news in the Malaysian economy. But whereas if you look at it, the manufacturing sector also seeing some improvements at 5.6%, mainly on the back of a revival in exports, as well as a lot of domestic activities. Here we're talking about manufacturing of building materials like steel and cement and all those sort of things. So that actually helped the manufacturing sector as well. The mining sector was the only one that recorded a contraction of about 4%. The rest were fairly stable. But by far the biggest one would be certainly the services sector. Growth moderated slightly. If you look at it, the first half of the year, there were a lot of, festivities. All right, the Chinese New Year, Hari Rayas, and what have you. So that actually boosted spending. But in the third quarter, services sector, growth was still there. In fact, pretty strong at 5.2%. But having said that, it was lower because of because there were no major festive events during that quarter. Domestic demand, very strong, continues to improve to about 7%, slightly better than what it was in the second quarter. So again, all of this mixed together, you can see the numbers generally on the uptrend, and that has actually helped the economy to actually post a fairly decent growth of about 5.3% year on year in the third quarter of 2024. Right. So I've actually gone ahead a little bit. Gone ahead. So some of the things I've already mentioned earlier. So this is just a summary of what has happened. Right. So in particular, what we do like is that there is a improvement in capex spending. So that is very important to assist the economy in looking forward to more growth in the ensuing quarters. Right. Okay. As I also said, exports of goods and services grew considerably, about 12%. That beat the 8.4% recorded in the second quarter of last year. Again, we also saw supporting the export growth was the export of goods, which grew almost 10%, double that of the second quarter this year. Manufacturing sector posted a strong rebound, mainly on the back of increase in E&E and primary related clusters. So primary related clusters here would be things like cement for building materials and things like that. So all this actually helped the manufacturing sector. So you look at the manufacturing statistics here: industrial production, exports, manufacturing sales, and manufacturing index. Very strong in the third quarter. Of course, it started to whittle down towards the last quarter of the year. But you can see that the trend is in 2024, the uptrend is generally on an uptrend. All right, so we expect that to continue into 2025. So on the outlook side, you can see that these are the consensus estimates pointing to sustained growth in most countries. For the world in 2025, we are looking at a growth of about 2.9% year on year. So for 2024, right now, the estimate is for 2.5% growth in 2024. But you can see that in most cases, most countries are likely to see sustained growth going into 2025. What are the positives that we are looking at? Easing inflationary pressure, sustained employment and wage growth, and of course, all this is supporting consumption, and that means that there will be increased spending. But interest rates, even though it's been reduced at this point, there is a possibility that going forward, interest rates reductions will be much slower than what we anticipated. So right now, possibly maybe just 2 times the Federal Reserve will reduce interest rates in 2025. But again, we'll see what happens thereafter. What has also happened is that, the recession odds now has dropped from about 50% to about 25%. So chances of a recession happening this year is pretty slim at this as we speak. So all this would actually help the global growth to continue into 2025. Yep. Okay. That was a rosy side. Now the less than rosy side. All right. So the biggest concern right now is President Trump. All right. So once he comes in, he is going to become Mr. Tariff. Okay. He's going to introduce tariffs on Canada, Mexico, Europe, and China, of course, bearing the brunt of it. So this is the biggest uncertainty at this point. So when that happens, it also means that when he imposes tariff, that also means that inflation will pick up. All right. So that is one of the reasons why central banks, or at least the Fed, is pulling back, tempering their expectation for interest rate cuts in 2025. Maybe just once, maybe twice. But even the prognosis is the next interest rate cut, if it does come around, will probably be in late second quarter. In other words, nothing much happening in the first half of this year. Okay. The other question is the global economy has risen very strongly has recovered very strongly over the past year or so, mainly because of pent-up spending. All right. So people save money during the COVID years, and then they had a lot of employment, and everything, they have money, they have spending. But right now the question is, all this has come to an end of a cycle. So is there going to be increase in consumer spending in 2025? So that one would be the biggest question. But having said that, at the current rate that we are looking at, there will still be consumer spending, but because the manufacturing side is still very slow, there will be slower capital investments. So so long as people are employed and there's decent wage growth, there will be continued spending. But whether people will spend or not, given the circumstances, that will be another question. All right. So whatever we look at it, the spending growth is estimated at around 3 to 4% for 2025. But overall, real growth will still be very small, very soft. All right. And looking at the current conditions, the US is going to lead the world in terms of economic growth. But if you look at Europe, Europe is still very slow and will remain slow for the time being. As far as Asia is concerned, as far as Asia is concerned, Asian economies should also fare better in 2025. But again, the caveat certainly will be, what if President Trump implements all his tariff threats? All right. So there has been talk that he may roll back on some of his proposed tariffs, but again, we don't know yet. So all will be revealed, I think, within the next few months. So that could also mean that the stock market will be quite choppy in the next few months. So looking at this chart, you can see that these are the forecasts. The line, the perforated line indicates 2025, first half of 2025. So what does that tell you? That is that, yes, some countries should see industrial production or manufacturing output rising, but in general, it's very much flatlined among the countries here, like US, Germany, France, UK, and China and Japan. So you can see that the recovery is certainly very much on the German side, which is depicted by the orange line. But even though it's on the way up, it's still on the negative side. Okay, so these are the forecast numbers. All right. Moving on. A bit slow. On the Malaysian side, all right. So third quarter numbers was very firm, and it certainly looks to be very encouraging, meeting expectations. So what does that mean? That also points to further improvements, a strong possibility of stronger growth, sustained growth. I wouldn't say stronger growth, I would say sustained growth into 2025, mainly underpinned by the combination of domestic activities and improvements in external demand. If you look at the consensus estimates here, you can see that real GDP is likely to moderate. All right. Again, the uncertainty here is mainly due to the external sector. All right. So for 2024, the whole year forecast is for the GDP to grow at 5.2%, but softer in 2025 as we speak at about 4.7%. So all this is actually due to the ongoing uncertainties in the global economy. In terms of interest rates, not much is expected in terms of hikes. They're still looking at the OPR at around 3%, whereas CPI could tip up slightly in 2025 because the government will be reducing subsidies. All right. So that means that there will be inflation is likely to come up in 2025, averaging about 2.5%. That's consensus. I'll provide you with the Bank Negara forecast or the government's forecast in a while. Okay, right. So much of the ongoing strength in the Malaysian economy is certainly going to extend into 2025. What are we looking for? Certainly the various initiatives and investments over the past year. Here we're talking about data centers and what have you. So all this is going to help the Malaysian economy grow at a pace of about 4.5 to 5.5% next year. Although the consensus estimate points to a lower 4.7% growth, right? Again, domestic activities and spending will be the main catalyst for the country's growth in 2025, backed by employment, strong employment, investments, and capex spending. And all this, of course, also ties into the minimum wage increase that will actually boost domestic spending. So domestic spending growth could moderate. I wouldn't say moderate slightly, like the growth rate is slightly to slow a bit to about 9.1% compared to the forecast of 7.5% in 2024. So again, the part of the increase in inflation is also due to the wage growth, right? So overall, you can look at this forecast here by the Bank Negara. So you can see that the services sector is still expected to lead the Malaysian economy going into 2025 at a growth of about 5.5%. Stronger growth is also expected in the manufacturing and agriculture sector, but the construction sector could slow down slightly after very strong growth over the past 2 years, but it's still very strong at 9.4%. Okay, so in terms of risk to all these forecasts, is certainly the slower than expected growth may come as a result of protectionist measures that could dampen global trade. So as you know, we are dependent a lot on China. So if China slows down, it's definitely going to have an impact on us. And of course, the other thing is slower interest rate cuts in 2025. So that could also reduce demand and external demand, and that also translates to lower export performance from our country, right? So back again, yeah, sorry. So that's why we're seeing the export growth moderating to just about 3.9% forecast for 2025 compared to 2024, which is about 5.6% year on year, right? Okay. Okay, moving on, the stock market review. All right, so 2024 has been a very strong year for equities. If you look at the MSCI All World Index, the second line here, it is up by about 16%. Obviously, the biggest performers were US equities. Here we have the S&P 500, 23%, NASDAQ, 29%. So, and the Dow Jones is only 13%. So you can see that it's another year of 20 plus % growth in US markets. Right? So that has been very strong. But even if you look at other countries, if you look at, for example, Germany's DAX and the Nikkei and Shanghai and Hang Seng, they've all posted very strong growth despite the economic challenges in 2024. But having said that, a lot of this is actually due to the very weak market sentiments in 2023. And so that has led to a recovery play in 2024. So in the US, it's certainly the mega caps, all right? And of course, the AI plays in the form of NVIDIA and all this sort of stocks that has sent the US markets to new record closings for a lot, on many occasions in 2024. Whereas if you look at Europe ended 2024 virtually unchanged, losing momentum in the second half of this year. So if you look at the chart on the other side, on the left side, you can see that the top half of the chart, you can see that the US markets, S&P 500 and the MSCI All World Index all moving up, whereas the European and Asian equities actually pointed down towards the end. So a lot of it is actually due to sentiments, uncertainties in Germany and of course also in Asian stock markets. But overall, there was an uptrend in 2024, mainly on the back of the AI teams and the mega caps run-ups. So there was also a revival in China stocks on its stimulus measures and as well as their improved external sector. On the Malaysian side, the CI actually registered a growth of about 13% in 2024, overturning 2 consecutive years of losses. All right, and it also meant that the gains in 2024, it was the strongest closing since 2020. It also emerged as the second best performer among Southeast Asian peers in 2024 after Singapore. So Singapore, the STI was the main performer. So what are the reasons that pushed the CI up? Was certainly the optimism over the country's data center investments. So that actually buoyed the construction and utility stocks that were seen as major beneficiaries. And of course, the revival of several high-profile infrastructure projects, one of which here is, of course, the RTS link in Johor. So at the same time also, there were quite a bit of funds coming in to the Malaysian stock market, particularly in the second to third quarter of the year. All right, in anticipation that the Fed will be reducing interest rates and then the strengthening of the ringgit as well. So as you can see from this, from the chart here, you can see that the big performers actually came very much in the fourth quarter of the year, except for the property, the top line there, the property stock that has gone up very strong. Construction index, that was the outperformer. So the rest of it actually were quite stable, but they were still on the way up since the start of the year. And of course, towards the end of the year, there were window dressing activities that pushed it up. Okay. So what happened? When the Fed said that they're going to reduce their interest rate increases, the tide turned. All right. So there were a lot of selling by foreign funds. If you look at the chart on the left, you can see that the green line is where foreign funds really sold down Malaysian equities from September onwards. So cumulatively, they have sold about 4.3 billion worth of shares. But if you look at retail players, they have been selling throughout the year. All right, the red line. So they have been selling to the tune of about 5.8 billion ringgit worth of shares since the start of the year. Right. Obviously, all these were all picked up by Malaysian institutions. So they were the big providing the big buying support to the tune of almost 11 billion for the year. In terms of average traded volumes, in the fourth quarter, the average traded volume was down by almost 30% compared to the second quarter of this year. And while the average daily traded volume was about 2.6 billion, down from the average of 3.5 billion in the previous quarter. All right. So moving on to the last section of my presentation is the global equity market outlook. Stocks have actually, globally, have actually endured a very uncertain start to the year. And of course, all this is partly due to uncertainties over President Trump's policies, right? So the market is actually expecting fresh trade disputes and increased protectionism from him. And what that means is that could slow global trade. And of course, slowing global trade means the slowdown in the global economic outlook in 2025. At the same time also, the Fed has said that they're going to slow down on their fiscal and monetary loosening policies. So that may induce further defensive strategies among stocks, and of course, conditions also will become more volatile. Looking at the earnings growth, we're still expecting something like a 10% earnings growth in 2025 on average globally. All right. But having said that, these estimates are very fluid at this point. It is subject to change. Depending on what happens over the next half a year, when President Trump's policies are announced. All right. Having said that, if you look at valuations continue to look very expensive, especially in the US side. So that could be something that markets will be looking very closely at, although the valuations remain fairly cheap in Europe, among Europe and Asian stocks. So a lot of companies, especially the American mega caps, they have been pushing the markets up over the past year, and they could also be the ones that will be under tremendous selling pressure if they fail to perform on the earnings side. So that means that, in our words, we think that there will be limited upside potential unless there is firmer fundamentals displayed by all these mega caps and stocks that have actually pushed the indices up in the past year, right? So looking at all of this, US equities are certainly looking the most expensive, well in excess of their long-term averages. And so we think that this is going to be very volatile for the start over the start of the year, right? If you look at it, still there is support provided by a lot of the US stocks in the form of very stable, sustained corporate earnings growth. So this might actually help to keep stocks elevated. But again, I don't think they're going to hold for very long because of President Trump's policies. So that might have an impact on global trade. But having said that, he is also very pro-business, so he might actually nudge, his policies might actually nudge, or at least keep sentiments on US stocks elevated for longer. In Europe, I would think that conditions still look very unsettled due to the frail economic outlook. But the only salvaging point is that valuations are still fairly cheap among European stocks, well below their longer-term averages. So that should support the European equities. But I don't see a lot of significant upside for the time being, given that the economic growth could still be lagging. All right. Same thing also we are seeing in Asian equities. At least in the first quarter of this year, we can think that the continuation of the choppy conditions are in the offing due to the prevailing uncertainties affecting global economies. Another point to contention would be the stronger US dollar. So stronger US dollar means that the Asian exports may be affected, and of course certainly corporate earnings as we speak. Right. In terms of earnings growth, like I said, corporate earnings should improve by about 10% in 2025, which is basically a vast improvement of the forecast contraction of 1.2% in 2024. So a lot of it actually comes from margin improvements, margin gains from lower interest rates, lower inflation, and all this is definitely going to help lower the input costs. In terms of valuation, you can see globally the MSCI All World Index, which is the lowest index there. You can see that it's still on 2025, 2026, it's still hovering around 17 to 19 times PE. So you compare that, average forward is only about 14 to 16 times. 16 times, so it's fairly expensive. But if you dissect that further, you can see that most of the high valuation is contributed by US equities, which continues to look very expensive, even after their pullback recently, right? Whereas Europe and Asian indices, their valuations still look fairly attractive. So, looking at the PE bands, you can see that the S&P 500 on the right side, the straight line is basically the average line. You can see that it's way above the average. All right. Whereas the other one, you can see that the All World Index is coming off slightly, mainly on the back of the reduced valuations of European and Asian equities. Right, moving on to the Malaysian side. I would say that I expect the Malaysian equities to actually remain very unsettled in the first quarter of this year. Already we are seeing that over the past week, right? We push the window dressing actually pushed the CI up to almost 1640. But over the past 2 days, we've lost 30 points already, right? So things are not looking that good, all right. Why am I saying that? Is because there's actually no change to the country's fundamentals as we speak. Everything is the same, all right. So now we are at the mercy of foreign markets and foreign events overseas that will continue to dictate the FBM KLCI's performances, all right. As I said before, President Trump's policies. So that is the biggest uncertainty at this point. And of course, at the same time, also the slower interest rate cuts overseas, that will also have a direct impact on Bursa Malaysia's performance. Particularly concerning is certainly the net selling by foreign funds. All right, until today they continue to be net sellers of Malaysian stocks. So retailers are also still selling, and local funds are supporting. I don't see them providing the support for too long because they have already spent more than 11 billion supporting the market. So they are the only net buyers. They are the only ones supporting the market. The more they support, the more people will throw. So that's the problem that we're going to face up. All right. However, but the only salvaging point right now is our valuations are inexpensive, relatively cheap. All right. There's still a lot of high visible projects like data centers, transportation projects, infrastructures and all this, and of course clean energy programs. So all this hopefully will provide the impetus for individual stocks to actually move higher as we speak. Okay, of course, the next one will be the Johor Singapore Special Economic Zone. All right, so the details, it has been signed, so we just have to wait for more details to emerge. So that might, of course, buoy construction stocks further, utility stocks, and Johor-centric stocks. All right, so that might be the ones that will provide the continued earnings growth into 2025. So what's going to happen? Today is actually at 1600 level already. Okay, so I think that local institutes are still providing support from foreign funds. Overall, I still think that the ongoing bearish streak might continue for a while. All right, buying will be very selective. Everybody's on a wait and see, and not willing to take new positions, even though stocks are getting cheaper. So when I wrote this was about 3 days ago. I expected the market to hold anywhere from 1600 to 1650. I think now we may have to revise that downwards slightly. Even the 1590 level looks a bit tricky at this point. So I would think that the worst case scenario may be about 1570 for the index. Again, it is a bit tricky at this point, given that the sentiments are very weak on equities as we speak. Even the broader market conditions are also looking very unsettled. Here I'm talking about the FBM small cap, FBM ACE markets. So there has been a very low retail following, and they have been, of course, net sellers for the past year, and they are continuing to do so. So as a result of it, I think sentiments are certainly not very strong at this point. But if anything, I think the investment strategy would certainly be looking at very defensive stocks. All right, defensive stocks, things like utilities and situational stocks that are likely to benefit from the ongoing, initiatives that are offered by the government. Here, we're talking about potentially stronger performances of construction stocks, given that there's a lot of contracts that are being doled out on a lot of these stocks. Okay, and some of the stocks that we also look at are becoming cheaper. So my colleagues will actually present to you some of the stock selections as we speak. So in terms of earnings growth, 2024, the earnings growth is looking at around 14% for 2024 on the CI stocks. Whereas if you look at the AMAS, we are looking at about 16%. For 2025, after the strong growth in 2024, the earnings growth is tipped to actually slow slightly. In fact, I wouldn't say slightly, quite considerably, to about just 2 to 3% on the CI and AMAS indices in 2024. 2025. But valuations, if you look at our historical averages, it's about 14 to 16 times as well, forward PEs. So right now, the valuations for both the AMAS and the FBM KLCI is practically fair at the lower end of the forward averages, about 14 to 16 times. There is certainly some room based on what we see right now and based on the potential earnings growth. The fair value, so to speak, is basically at around 1700 to 1750 on the CI. But of course, this is a year-end target, So that implies basically an upside of about 8% as at today, all right? But along the way, there will be a lot of volatility. Okay. So again, you can see that the PE bands, FBM KLCI index, we continue to trend below the average line, the broken line on the chart on the right side, on the left side, sorry. And if you look at the PE band where we are right now, we are on the forward side, we are fairly fair at this point. All right. So with that, I have come to the end of my presentation. In summary, I think things will be a bit choppy in the first quarter of this year. The strategy would certainly be to be on the defensive side at this point. Look at companies with stable earnings, dividend plays, and certainly companies that I would think should benefit from the ongoing projects that we have. It will certainly be the construction side, even though it's a bit on the high side, but I think they should provide support to your investments over the near term, right? So with that, I will pass the rostrum to my colleague Chu Hong, and will provide you with some of the companies and sectors that we think will outperform in the first quarter of this year. All right. Thank you very much.
Hello, everyone. So this is Chu Hong. So today I will be talking about a few companies. First one is under our coverage, which is Hapseng Plantations. So this is one of the companies that we've been talking about in the past 2 quarters. And alongside that, I will also be doing a sectoral review, very much a summarized review as to what has actually happened to plantations over the past year. So as you can see that for plantations, the sector PE is still very much below the pre-pandemic level at about 19.7 times. In the past 5 years, average is about 33.6 times. If you can look at the chart itself, across all the sectors, a bit difficult for you to see, but from the bottom towards up, it's the fifth one. Yes, actually outperformed some of the sectors in the past year, being energy, telecommunications, industrial, consumers, and technologies. So for the whole year, yes, actually came up about 9% for the whole year. So that is in part due to an increase in terms of CPO prices towards the end of the year, whereby we were looking at about 5,300 ringgit for the CPO at the time when it was somewhere around November. But the price has now come down to trade on a more normalized level at about 4,002, which is something that we have actually mentioned about before, saying that CPO prices being trading at a premium against soybean oil is very much unsustainable. So it has now trade at somewhere around a more normalized level, which we think will still be able to provide a very steady margin moving forward with this level. And so looking forward, we're also looking at fertilizer costs that's very much stable quarter on quarter, and with labor constraints now easing, we should be able to very much hold up the operating margin for FY25. For the past 3 months, we've been seeing CPO prices coming up. So alongside with the higher FFB production in November and October period, we are now expecting plantations companies to very much getting a better performance for the last three months of CY 2024. So like what I mentioned just now, FCPO movement, as you can see that in somewhere around June or July, the candlestick chart is the FCPO. So it's been trading at a premium compared to soybean oil. So that has been coming down, and today we are looking at the level whereby CPO futures has been trading at somewhere around 4,200 level. So for the whole year, we expect the CPO prices to still range somewhere around 4,000 to 4,005. Firstly, because there is more and more constraining outputs coming from Indonesia for palm oil. And Indonesian policies currently, they are trying to restrict it as much as possible so as to increase domestic usage for CPO. So what they have done is that they are looking to increase their export levy from 7.5% flat rate to 10% flat rate. And for CY25, we're also expecting the seasonality factors to come into play. So CPO prices should still be very much held up on a lower FFB production. So with that, the La Nina onset should be expected. That there's more and more probability showing that La Nina might be coming in. So there will be some changes in terms of the weather pattern. So overall, it's still showing that that is a very constraining level in terms of CPO prices coming from Indonesia, and in fact from this part of the world whereby we are the majority of where the CPO is coming from. And at the same time, if you look at the soybean oil price, it has been at a lower base. So that is mainly because of bumper harvest outlook in South America and Argentina. So that will also affect how CPO will be looking for the next year to come. So with that, the soybean oil coming down to this level might show that there might be lower probability for CPO prices to go downside at the moment. Next. So one of the company that we've been talking about in the past 2 quarters, later on I'll have more stock picks which I wish to share. That is not under our usual coverage. So this one is under my coverage. So this company is a mid-sized palm oil plantation company. So it's got 34.9 thousand hectares of planted area in Sabah. It has got 4 palm oil mills and 3 biogas plants, and biogas plants is purely for electricity generation. That they don't have that what's it called, electricity generations that is sold to TMB at the moment. So the current market cap is somewhere around 1.52 billion, with closing price today is about 1 ringgit 90 cents. The number of shares currently stands at about 799 million. Overall, some of the key merits which I think Hapseng Plants has got is the age profile is still relatively prime at 17 years. There's been very healthy replanting trend over the past a few years, about 1,000 hectares per year. That's about 4%, which is somewhere around the guidelines where MPOB was saying that, it's sustainable. And overall, the balance sheet is still very strong. The net profit position is somewhere around 70.9 cents per share. There's no borrowings at all for this company, and it is currently trading at quite an undemanding valuations, which is its PB is somewhere around 0.74 times, and the P is somewhere around 11.4 times. So for the Plantation company at the moment, if I take companies that is from 500 million to 3 billion market cap, they are all trading somewhere around price to book value of 1.3 times and PE at somewhere around 15 to 16 times. So with that, we think that Hub Seng Plantation is still a buy. Our TP currently is at 2 ringgit 33 cents. That is based on a PB of 0.9 times, which is pegged to our 2025 earnings of book value per share of 2 ringgit 59 cents. So that is very much a potential upside of 22.6% from today's closing price at 1 ringgit 90 cents. So some of the financial highlights which I would like to point to you will be that the revenue in the third quarter, which is their latest results, has actually improved by 7.7%. That is mostly due to higher average CPO and PK prices. Overall, as you can see, the core profit have actually increased by 75.5%, and that is mainly due to higher FFB production and harvesting, which also resulted in the lower production costs. So for the fourth quarter, which is the upcoming quarterly results, we think that the results will be improved, or if not sustained, mostly due to, like what I mentioned just now, October, November is a peak crop seasonality period, which means that the FFB production will be good, and at the same time, the CPO and PK prices actually hit about 5,300 during that time. So overall, for the whole year, 2024, we expect the core PAT to improve by 55%, and our dividend expectations at the moment is still very much maintained at about 10 cents for CY24. So some of the potential upsides to price, what I mentioned just now, will be some of the bio diesel mandates for B to B40, but this has been delayed to February currently for Indonesia. That was also partly the reason why FCPO has been trading quite sluggishly over the past few days. And there's been also discussions whereby it's saying that the palm oil biodiesel mandates might actually increase to B50. Some of the other updates, such as EU Commission's proposing a delay to EUDR implementation, some of these will potentially provide some upsides to the CPO prices as well. And what I mentioned just now, La Nina onset for FY25 affecting production. And for the downside risk will be the bumper harvest of soybean, which I've actually already seen with the soy oil trading at a very low base at the moment. So any changes in terms of the expectations, if the market thinks that soybean oil is not going to soybean oil harvest is not going to be as good as initially expected, that might actually have an impact onto CPO prices as well. So that will kind of hold it, if not sustain it. Overall, moving forward, we believe that the margin prospects will still be stable. And recently, there's been discussions coming from the budget 2025. There have been changes in terms of minimum wage, which we think that it is going to be minimal. And mainly that is because it is going to be offset by the revision in terms of the windfall profit levy, which is 3%. Now it's for the East Malaysia is now 3,150 and West Malaysia is 3,650. And for the export tax, there's also been some restructuring from the initial level to 10%. Okay, next. So the reason why we still like defensive sectors such as plantations, like what Victor has actually mentioned just now, is that the market is still very much unsettled. look at sectors that are more defensive and that pays dividends well. And in fact, today I'll be talking about some of the companies that's got cheaper valuations as compared to their industry average. So we believe that for the whole year, 4003 is still our business assumptions at the moment on sustained CPO prices and PK price outlook. That should very much buoy the outlook for the plantation sector. And we also like Plantation due to the sustained dividend yield outlook, and some of the companies which we like has got high cash generating capabilities, low net gearing margin. And in particular, we favor companies with improving profitability, whereby those, the company fundamentals has not actually been reflected in the market itself. And also we like what I mentioned just now, the multiple valuations that is low, and also we like plantation companies that are very much focusing in upstream players and very much on pure plantings instead of downstream, because downstream is still very much being counteracted by Indonesians competition. So one of the stock picks other than those under our coverage for harvesting plants will be Sarawak oil palms. So a little bit of understanding of Sarawak oil palms on their operational statistics. As you can see, the planted area is 82,000 hectares. Crop age relatively young, about 13 years, and FFB yield not the best, but there's been trend of improvement trends, and OER is very much industry average, as you can see, about 20.6%. So the current PE is about 9.2 times. That's 12 months trailing, which is lower than the average of 16. PB is also trading at 0.8 times, below the average of 1.3 times. The dividend currently, we're looking at it 3.6%. Not the best in the market, but later I will get to that a little bit more. The market cap 2.7 billion, number of shares about 900 million, and the share price today is about 2.98. So on to SOP's profitability analysis. As you can see, that has been on an uptrend mainly because of a higher CPO and PK prices in FY 21-22, and 22 has come down a bit because CPO prices has come down a little bit. But as you can see that for FY 24, for 9 months, it's already surpassed FY 23's performance. As you can see, 306 million of earnings. That's mainly because of higher CPO prices. So we expect that for the fourth quarter 24, we'll bring the earnings up to at least 400 million, and that is at least the consensus net profit, where it's currently placed at about 407.8 million. So if you look at these companies, the cash level has been improving over the past few years. Something that I wish to point to your attention would be how much they have been increasing their net cash level. So the net cash level is somewhere around 1.1 billion, which accounts for about 41% of the market cap at the moment. What they're going to be doing with the 1.1 billion, I can't say for sure, but as you can see, the dividend payouts have been on the uptrend. So they have got higher, better dividend payout capacity moving forward. It's either they are going to be paying out higher dividends. I don't know. They could be doing that, or they could be, using that money to that 1.1 billion net cash to increase their efficiency in terms of their FFB productions, and and potentially increase their plantations estates, which might turn into earnings as well. So another topic which has got very similar characteristics as well will be Jaya Tiasa. Planted hectareage about 68,000 hectares, FFB yield about 17 metric tons, slightly better. OER about 19%. So dividend trailing for the past 12 months, about 4.6%, relatively better. And the P and PB ratio is 9.8 and 0.9, which are still lower than the average, as you can see. So the market cap today is 1.2 billion. Shares is 970 million, and current price is trading at 1.22. So similarly, with SOP, as you can see that the profitability has been improving after they have been downsizing their timber operations. So their timber operations their earnings has been, their losses has been narrowing. So palm oil segment currently for the whole year for FY 2024 has been contributing about 95% of the whole revenue in FY 24. So similarly with other plantation sectors for second quarter of FY 25, we expect the earnings to sustain our CPO prices. The net cash level, as you can see, that has returned back to a positive position. So overall, there's been the improving capacity to pay consistent dividends as well. And as you can see, in fact, it's been very much evident in the past few years that the dividend payout has been coming up to about 6 cents in FY24, and the dividend yield has been increased year on year consistently to about 4 point something to about 5% in terms of dividends. So with that, I end my presentation for today. Most importantly, what I wanted to say is that despite the CPO prices coming down to about 4,200, there is still some demand factors coming from CPO that will very much support the CPO price itself to trade somewhere around 4,000 to 4,005, which is what we call a new normal for CPO prices moving forward. And some of the reasons which I have mentioned to you just now will very much support this. And at the same time, some of the companies which I think will have cheap valuations will be some of the companies that you might want to have a look at, which I mentioned just now, SOP and Jayatiasa. And in particular for SOP, as you can see that the net cash position has actually accounts for about 41% of its market cap, which improve its dividend paying capacity. And if not, then that might be, moving forward, there might be an increase in terms of their hectareage, it might be increase in terms of their productivity. We don't know what they are going to be doing, but it's good to know that there's this company whereby there's got good cash reserve, and the valuation still very much remain undemanding at the moment. So with that, I'll end my presentations. And
Choo Hong, before you end, we actually have a question from online. Yeah.
Okay.
So there's an audience asking, since you have been covering and sharing on your favor on all this plantation company, okay, yeah. So does all this criteria that you have been mentioning that applicable to GTSR, all this, is it happening the same to all other plantation companies, or just these three selected one that you share with us? I think particularly that he's looking at it is JPG.
JPG has just been JPG has got a really high gearing ratio as compared to plantation average. So for most of the plantation companies, they've mostly been in a net cash position. So if you are looking at JPG, the profitability over the past few years, I believe it has been very much sustainable. And overall, I think that the profitability will still be very much alike to what I've mentioned just now.
Yeah, so like what you mentioned is most of them, they should be in net cash, like what Choo Hong been mentioned for
but,
plantation.
I believe that their gearing ratio
is something that we should be looking at individually on each counters, each companies. Yeah, so I believe this is what Gasha is asking. Yeah. For net cash wise, then broadly should be all the same, but we have to more focus on the profitability for each plantation company, and also the gearing ratio in order to choose the best one for him. And from Choo Hong today, we have three that he think is the best for us to look at it at current valuation, right? Okay, thank you very much, Choo Hong. Any other questions from the floor? If not, then we're gonna proceed with Chloe to share with her view on and her counter. If not, thank you, Chu Hong.
Thank you.
Hi everyone, my name is Chloe and today I'll be presenting two companies and the first one would be Pentamaster Corporation Berhad. Next. So first of all, Pentamaster is a leading global provider of advanced automation, manufacturing and technology solutions. And they specialize in two primary segments, which are automated test equipment, ATE, and the factory automation solutions, FAS. So the group serves a wide range of high growth sectors, which include medical devices, automotive, semiconductor, electro-optical, consumer and industrial products. So its main production facilities is located in Bayan Lepas and Batu Kawan in Penang, and they have also expanded their footprint internationally. That includes a facility in China, as well as sales and technical support offices in the US, Japan, Germany, and Singapore. So looking at the group segmental performance from CY21 to CY23, the ATE segment contributed approximately 65 to 70% of the group's revenue, driven by the automotive industry's transformative shift towards EV. But however, for the first time in CY24, the FAS segment has surpassed the ATE segment in revenue contribution. This is due to the surge in sales to the medical devices customers. So Pentamaster has a strong order book of 420 million, which with approximately 60% of the orders coming from the medical devices customers within the FAS segment. And this is due to the rising adoption of the automation in medical manufacturing. As the ATE segment is experiencing slower demand in the automotive sector after years of rapid growth, so we believe that the FAS segment now is expected to remain a key earnings driver for the group in CY25, especially from the medical devices customers. So Pentamaster is actively broadening its business exposure in the medical device segment via its subsidiary, Pentamaster Medicure Central Berhad. So they are targeting single-use medical devices. And their third manufacturing plant in Batu Kawan is expected to complete by first quarter of CY25, and it spans around 720,000 square feet. So it mainly caters for the growing demand in the medical devices segment. So CY25 sales momentum will also be supported by other key segments, for example, the electro-optical segment, which is projected to sustain its double-digit growth, driven by the strong demand for their group's flagship smart sensor test equipment for the upgraded version for the ambient light sensors. So in addition to that, Pentamaster has also ventured into another high growth industry, which is the renewable energy segment. So they are focusing on the automated solutions for the manufacturing and the testing of the renewable energy components such as the solar cells. So currently it is receiving repeat orders from the US customers. So while the revenue contribution from the renewable energy segment is still minimal at this stage, but the group is actively working on expanding its presence in this industry. So it is projected to account for around 10% of the group's revenue in the coming year. So moving on to the recent development, last month, Pentamaster has announced plans to privatize its 63.9% owned Hong Kong listed subsidiary, Pentamaster International Limited, in partnership with Puga Holdings Limited. So Pentamaster will increase its stake from 63.9% to 71% by acquiring an additional 170 million PIL shares at the price of 93 cents. So at this price, this reflects a 16.25 premium over PIL's last traded price of 80 cents before the trade suspension in December. But we think that despite this premium, this privatization is quite attractive because it values PIL at a trading PER of about nine times, which is substantially lower than the Pentamaster's own trading PER of 40 times. So By privatizing PRL, Panda Master aims to streamline its operations and then reduce the regulatory costs and unlock greater operational value of PIL. And this privatization is also expected to be earnings accretive for Panda Master as it consolidates a larger share of the PIL's profits. So therefore, we maintain our buy recommendation, and then we also raise our CY25 earnings forecast slightly to reflect Panda Master's increased stake in PIL, leading to a higher TP of 4 ringgit and 85 cents. So this is based on ascribing an unchanged PER of 35 times to the and pegged to the CY25 revised EPS of 13.9 cents. So this represents a potential upside of around 24%. Next. So now I move on to the second company, which is Supercomet Technologies Berhad. This company primarily involves in the manufacturing of medical devices. So Supercomet is principally engaged in the manufacturing and assembly of wires and cables for various industries such as medical devices, automotive, electrical appliances, and consumer electronics. So their operations are divided into 3 segments, which are medical, automotive, and industrial. Looking at the segmental performance for the first 9 months of CY24, we can see that the medical segment is the largest contributor, accounting for around 80% of the group's revenue, and then followed by the industrial segment contributing 18%, and the automotive only contributes 3% at this moment, because this low contribution is due to its major automotive customer restructuring its manufacturing lines since 2023, so dampening the sales from this segment. So nevertheless, Scomnet has a strong client base across 3 segments, with its key medical clients, customer E and customer A, they each contributing approximately 38% of the group's revenue in the first 9 months of CY24. So looking at the Scomnet's financial performance over the past 5 years, its revenue showed an uptrend from CY20 to CY22, but it declined in CY23 because of the temporary weaknesses in the automotive segment. But despite this, the medical segment remained resilient, and this is because the group has strategically prioritized high-margin business opportunities, for example, by shifting to manufacture whole medical devices, leading to an improved profit margin and reaching 21% in CY23. But that said, 9M CY24 profit margin was slightly lower. This is due to the forex loss in the third quarter. So for 2025, we anticipate revenue to grow to around 250 million and PAT around 46 million. So this will be driven by several key growth factors. So Scomnet is poised to benefit from the rapidly growing medical devices market, which remains its primary growth driver, supported by strong demand for existing products, coupled with the introduction of several new products for its 2 largest customers. For customer A, the robust orders for single-use endoscopes will continue, and the launch and mass production of EEG electrode wires is targeted for June this year, will contribute significantly after some earlier delays due to technical setbacks. So as for customer E, their new product, smart cables used for critical care monitoring, has commenced productions for 2 models, and the 3rd model will start mass production in the first quarter of CY25. Meanwhile, for the automotive segment, we anticipate a gradual recovery of sales driven by the onboarding of a new French automotive customer. So this customer will help diversify Scomnet's automotive client base and reduce reliance on its current major customer, which has temporarily paused their orders. So additionally, the relocation of its automotive production to the new plant in Gurun, Kedah by second quarter this year will free up space at the existing plant, so allowing for more production capacity to support the rising orders in the medical segment. So with that, we maintain our buy recommendation on SCOMNET with a target price of 1 ringgit 76 cent. This is based on ascribing a target PER of 33 times pegged to the CY25F EPS of 5.3 cent. So indicating a potential upside of around 29%. So looking from the technical perspective, SCOMNET presents a compelling buy opportunity. Firstly, the stock has a strong support line at around 1 ringgit and 20 cent, which has remained intact for the past few months. And recent price movements have pushed the stock above its 200-day moving average, which is the red line, and signaling a bullish momentum. So it has also broken above a key downtrend line, which is the blue line, and indicating a potential reversal and the start of an uptrend. So the immediate key resistance level is to watch a 1 ringgit 45 cent and 1 ringgit 60 cent. So a breakout above these levels would further confirm the bullish outlook. So thank you, and this comes to the end of my presentation, and I pass the floor to Jesse.
Before you pass over, can
Yeah.
I ask one question?
Yeah.
The target price mentioned by you is 136.
176.
176.
Yeah. Yeah, 176. 136 is today's closing price.
Okay, but the PE based on the KRAC screen
Yeah.
is 39.05. So do you think the valuation is already very rich?
Now the trading is 39 times. Right.
39.
We think because last year's earnings was affected by the automotive sector, that's why the trading PE should seems to be higher. But after the onboarding of the new customer next year, the earnings will improve and therefore lead to like lower PE. Yeah. Did I answer your question? Okay, thank you.
Testing. Good evening, everyone. I'm Jessie. So I'll be talking about Clangdon Group Berhad for some company updates of it. So KGB is principally engaged in the business of providing engineering services, construction, and general trading. The revenue generated, they generated the revenue through ultra high purity segment, process engineering segment, general contracting segment, industrial gas segment, equipment and materials segment. So they are mainly serving Malaysia, Singapore, and China market. So for UHP segment, KGB is mainly involved in building and fabrication of piping, interconnections of the delivery system, and installation of different equipment to the system, which we call it as hookup projects. So for this segment, they are mainly serving the upstream semiconductor companies that based in Germany, China, and Singapore. For general contracting segment, KGB will be providing general contracting works such as civil, mechanical, and engineering services to construct specialized facilities such as clean rooms and R&D centers for the also semiconductor companies. And the projects are mainly based in Malaysia. For process engineering segment, KGB will be providing M&E construction for process plants, designing and constructing underground pipelines to support industrial processes across many sectors. And then for this segment, the project are also based in Malaysia. So for the industrial gases segment, KGB will be manufacturing and distributing liquid carbon dioxide through ACE gases, which is their subsidiary. So KGB own 2 LCO2 plants at Kedai Terengganu, and then for this segment, the company is mainly catering the demand and also mainly export the LCO2 to the other countries, mainly like Oceania countries and also Indonesia. So some updates for UHP segment as at 30th of September 2024, KGB has secured about 1.08 billion worth of order book under UHP segment, and despite the management sees a slowdown in the UHP's project tender from the Chinese market, but according to Semi Organization article, they're talking about China's chip manufacturing capacity is expected to grow by 14% this year. So besides for this mixed outlook by the management and also Semi Organization, the group also sees some potential for order book growth in the German market as it accounts for 35% of the 9-month CY24 tender book. So for industrial gas segment, KGB is running both of its LCO2 Plant 1 and Plant 2 at an overall utilization rate of 60%. And just about November, KGB has completed its acquisition of the remaining 9.29% shares in Ace Gases, which is the subsidiary that I mentioned just now, and they are engaging in converting the waste carbon dioxide gases into liquid carbon dioxide. So this acquisition will give a full consolidation of earnings to the group, which should drive a further 10% growth in the group's bottom line starting last month, which is December 2024. And besides from this, KGB also secured a piece of land adjacent to both plants, and which enable further expansion to meet the growing LCO2 demand from the overseas market. Therefore, we recommend a buy call for KGB with a target price of 4.02, indicating a potential upside of 17.2% based on today's closing price of 3.43. And my recommendation is supported by its robust order book and tender book. So given that KGB's clients under UHP segment are mainly the chip makers, so we are optimistic about its earnings visibility and sustainable profitability with over the quarters as KGB penetrate into German market, and with the China chips manufacturing capacity is expected to grow this year. We also like KGB for its dividend stability by leveraging the stable income from its industrial gas segment. And as you see, for CY23, the KGB has been declared 4 cents for the full year, but as at 9 months CY24, they have been increasing their dividend payout to 6 cents. So we might expecting more for CY25. Yeah, that's all. Thank you. So I will pass the floor to Elkie.
All right, thank you, Jessie. Anyone have any questions for Jessie before I take over the? No. All right. Okay. Thank you very much to Jessie, Chloe, and Chu Hong for their sharing on the picks. Okay. All right. Okay. So finally it's my turns. Okay. So my turn will be the very last session. Okay. And I will be mainly talking about technical analysis TA part. Okay. Before I start, let me introduce myself. My name is Elkie. Okay, ELKY. And I'm not a research analyst. Okay, just to make it clear, I'm not a research analyst. I'm actually a dealer from dealing team. Okay, and I've been in this industry. I am still very young compared to all of you right over here. I'm only in this industry for like 10 plus years. Okay, I was a proprietary trader once. So from there, I've been learned and taught to how to read the charts. Okay, and on daily basis, we look at more than easily 300 to 500 charts every day, every single day. So 1 year is about like 200 plus days, trading days like that. So I've been doing that for 10 years. Okay, so I will be sharing with you guys on some of my reading on the charts and based on some experience, based on some tools, indicators over there, and hopefully it able to help you guys to get some ideas on what's happening, all this. Okay, and if you have any questions or any stocks that in your mind that you would like to, I always want to know what is the chart outlook, technical outlook for these stocks. Feel free to throw me at the end of my section. Okay, I will try my best to help you guys. Okay, same with those audience online. Okay, yeah. All right. So let us start with a disclaimer. Okay, so I'm not a research analyst, and all the sharing that I'm gonna share with you guys later is not a buy call. Okay, as a dealer, we only can share tell buy sell to our clients, but today will be more towards education purposes, just a sharing with you guys some of the insights and thoughts. Okay, it's not investment advice at all. Okay, but these are some of my thinking. Okay, and for these sessions, I've been thinking since December. Oh wow, what should I put for the 4 stock pick for this first quarter of market outlook? Wow, very headache. Construction move. The top 4 already moved. Gamuda, IJM, Suncon all moved so high already. So what other thing that should I put? So I've been thinking this a lot, and I will be sharing with you guys shortly later. Okay, hopefully if it comes in line with you, can click. Our channel can link together. Then you might want to consider to see if you want to buy it or not. Okay, yeah. So before I start with all this, these are some of the stock pick updates since the last quarter. Okay, yeah. So if any of you guys haven't been following us on our Facebook or on our YouTube, later at the end, the very last slides of my section, I will share with you guys what are the things you can search up to follow us. So basically, every quarter, me and research team will be sharing on the market insights and also some of the picks that we share with you guys. So this is some of the updates for the last quarter. That's I believe in October. So during the time, it was I was sharing on HSS Engineering, Jaya Tiasa, Mr. DIY, and also OCK. Okay, so among 4 of us, 4 of this pick, Jaya Tiasa is the one that most performing. It up the highest it reached is about 30% from where we were I was putting up in October. Yeah, but however, the view right now for Jaya Tiasa is more towards it's trending lower, in line with what we are seeing on the CPO price. Okay, yeah, so it has been trending lower, and from the rally, it has turned into a downtrend at this moment. Other than that, for HSS Engineering and OCK, it's more towards on the downside, but HSS Engineering, we might see further weakness if it trades below the 1 ringgit, despite that yesterday it announced getting some solar related project. Okay, and OCK wise is sideways but more upsides. Okay, so if you are interested in OCK since last quarter, you have been listening, then you might want to continue monitor on OCK as well. Okay, as for Mr. DIY, it's further downside as well, same like HSS Engineering. Okay, yep. So if we look throughout the whole year, we have been sharing the technical pick for 3 quarters. We didn't do it for the first quarter of 2024. Okay, so these are the top 5 gainers and top 5 losers for the year 2024. And out from them is the top one is HSS Engineering, which was being called to, I believe I was sharing HSS Engineering right over here, exactly last year in April over here, and that was to collect at the 80 something cents, and from that it went to 50% up from there. Okay, yeah. So following that will be Kosan FFB. So any of you have attended last year's section with us together right here, these are some of the picks that you might be familiar with. Okay, but also of course we have some losers over there, which Opstar is one that hit the stop loss and it went much further to down more than 50% for the year. Okay, yeah, so it hit our stop loss and went very much lower. Okay, and other than that will be MRCB and also Mr. DY on the results, NPAX and Kosan as well. So you can see Kosan actually went down 15%, then only it went up to close the year almost 40% gain for the year. Okay, yeah, so it's quite a bumpy and volatile move for Glove last year. Okay, yep. So for throughout the whole year, we can see that these are the 12 picks that have been put up. Okay, and all in all, the performance is the total return. It will come back somewhere around like near to 8%. And in all, we have most of the losses are lesser. Okay, while those that performing and right on it at the end of December 31st is still performing. Okay, but if you are really like God like that and can sell at the highest price, then of course the return will be much higher, which we know that it is quite impossible. Okay, yep. So what happened in 2024? I believe Victor shared quite a lot already just now. Okay, so if we look just a recap on what happened in 2024, we can see that construction, property, utilities, these are the three sectors that have been really performing. And if you close your eyes and hantam any stocks from these sectors, big one, big large cap, then most likely you should be performing, your portfolio should be performing for last year. Okay, and the laggards one for last year, it will be more towards telco and also consumer products. Okay, yep. So if we look into why some of these they have been performing or they have been lagging, okay, like for constructions we have been talking about, and you guys have been in this industry throughout the whole year. We know that data center DC is the one that have been driving the funds, the markets, the shares. That as long as it's related with DC, we are seeing that it has been going up very strongly for last year, especially constructions. A lot of awards dish out, and it drive and the growth, anticipation of the growth in the constructions, and it drove them up in 2024. And of course, with the utilities as well, they are with data center. They are expecting data center to consume a lot of electricity and water, cooling down the chips, all this. Yeah, so utilities, surprisingly, instead of being defensive, it has come in and become one of the sectors that everyone been looking at it. Not only in Malaysia but also in US globally. Okay, with the expansion of data center throughout the globe. Okay, and also it comes in line with our government energy transition goal and in NETR. Okay, with the solar, with Tenaga, all this. So that's why we are seeing utilities have been really performing for the last year. And again, property is also with this expansion. We see industrial property been moving up, the industrial lands deals, all this, and also with JSSEZAC that has been just signed. I think is this week, early of this week, right? Yeah. So they have been driving the property, and healthcare. It will be more towards driven by the glove makers. That's been lifted on the US-China trade tensions. Okay, yeah. But as for the laggards one, like telco and consumer products, telco will be on the delay of the dual network model. Okay, consumer products will be, we know we have some boycotts over like some Starbucks, Maggi Mee, Nestle, all this, yeah, and also the carefully cautious spending with the removal of subsidies. And also some a bit on energy with the reduced capex, and also uncertainties on oil demand with a weakness in the from China. Okay, so some of these catalysts, and these are the news that have happening for the 2024. Okay, and that actually brought us to where we are today. Okay, so if we look into some of these charts, this few industry or the sectors, should we be still looking at it, or should we be changing. Okay, so if we look at our construction sector, okay, if we look at construction sector, okay, this is construction index. Okay, very obvious. You can see that a construction index is a continuation on its rally. Okay, we can see the construction index has been rallying. Okay, we can see it has been rallying from the bottom to go up in up to July, and then in August we start to see some profit taking, some selling, and it has been quiet throughout the end of December, and until now we are seeing the starting of some movements. Okay, yeah. So construction wise, we are seeing the upward move again. Basically, the engine start again after they have been taking a break for 4 to 5 months. Okay, so construction wise, it's still a continued upwards, and it might continue to go higher for this year. Okay, next we will have the utilities. Okay, so how about the utilities? Are we should we still continue to look into utility index, utility related stocks? Okay, if we look into utility index wise, we can see utilities index is reaching the previous resistance of 1880. Okay, and at this point of view is it's likely that this 1880 to be resisted. And in fact, this chart is as of yesterday closing. I was doing yesterday. I haven't up. If we look into the charts today for utility index, we should see a very strong bearish candle. That's telling us it's a bearish engulfing, and it's telling us it's a rejection from the resistance 1880. So with today's selling from near the 1880 levels, which is at the end right over there, we might see a retracement, a pullback, a weakening in the utilities related stocks for the next few days, where if the selling is massive and coming back to 1600, this could even be a double top formations. Okay, but I doubt that will happen. I will see that with the data center thematic going on, the growing needs over there, we should see it should be holding above 1700 levels. This should be a healthy retracement. Okay, more towards like a healthy retracement, somewhere like this. Okay, it has been moving up, it retraces a bit, then it might go up. So you can, for those that you haven't been using technical analysis, one tools that you can use is you can use this blue lines. Okay, this blue line is 20 days moving average. So this is trading view chart that I'm using. You just go to trading view, you just type Bursa Malaysia Utilities, then the chart will pop up. Then you can add indicator 20 days moving average. Okay, so you can see the very good chances that it might come to the 20 days moving average, hug along with the line and start to rebound. Given that it has started to forming a trend. Okay, so this is what we are talking about. Whenever people talking about buy along with the trend, this is the trend, and we are seeing utility stocks index is trying to form into a trend. Okay, so just that right now it's moved a little bit too far, and then it has to come back to the earth, to the line, and then go higher again. Okay, yeah, so you can put that up and then use that as a reference. Okay, next we have property. Okay, property again is also retesting the high. Okay, it's also retesting the high, and with the retest of the high, we are seeing the weakness. Okay, so some of you guys might be wondering, hey, okay, this TA, is it true or not? Is it really Juna? So you can see, it just come to the same high level and then it just come down for no reason. That's the power of TA. It just come to the area whereby everyone generally the markets thinking that at this price it could be a little bit expensive, then the price starts to coming down, some profit taking happening. Okay, yeah, but however, if some of the property big cap, they able to maintain at this price, Okay, they retrace a bit, maintain still at the high. That actually would convince the investor that this is the new price range that we are looking at it, and we might see more catalysts with the Johor, Singapore, SCX signing. We are seeing more catalysts to come in, all this. And the breakouts, if breakout really happen, then we will see it develop into an uptrend. Otherwise, as long this high 1660 level, 1160 level remain resisted, then we should see property stocks to trading on sideways rather than a strong uptrend. Okay. Then healthcare. Okay. So healthcare, what we are seeing on healthcare is healthcare has broke previous high in May. Okay. This the high in May, and then the sell downs. Okay. This this should be the high when they starting to talk about the starting of the tariff. Okay, then Trump added up. Okay, yep. So although we had the breakout on the healthcare, we can see that it was unsustainable. It break out further, and then we don't see the momentum over there at this over here. So you can see the upward is up, green, red. That's telling us that the momentum is not there. Those that with momentum is a long green bar like that. Okay, you can see the green bar is more than the red bar. So that will be telling us the momentum, just like right over here, the momentum is there. Okay, so whenever, if you are really reading into the charts, if you're interested, whenever you see green, red like this, these are the signals that the markets is not strong. The moment people are confused and they are worried, they are being really cautious, and from there it has a good chance of the price to come down. Okay, so for healthcare, we are seeing more room for retracements, and we are seeing that happen today. Okay, Hatalega, Top Glove, most of the glove they have been coming lower. Okay, yeah. So this is as of yesterday, lah. So adding on to day one, then we should see another long red candle coming down. Okay, so if for some of any of you guys that still believe that tariff it will still be there, glove average ASP for their glove will still going higher, their sales will be better. Where to look at for healthcare? You can look at this line at 2060 area. This could be a support area for the healthcare or the glove stocks. You might look into this area to see some short-term support for healthcare related or glove related stocks. Okay, so that will be the view of for the gainers on their all these gainers in sector index. So overall, we can see that construction is still upward continuation, is still very strong, where the the property is testing the high, utilities is testing the high. It's more towards sideways, while the healthcare is poised for a further downwards. So out of the 4 performing sectors last year, we from technical aspect, we are more favorable to look into construction, to stick with constructions. How about the laggards? These are some of the counters that have been lagging for last year. Is there any chance, any cheap stocks that we can, or the good sector that we should be looking at it? Okay, so we start with telco. Okay, so one trick to share with you guys, if you guys are interested, is to pick up some of the stocks that could be bottoming. Okay, if you guys like to buy at the bottom, at the lowest. Okay, so to find if the sector has the potential of bottoming, is you can use these tools right over here, MACD. Okay, so if any of you guys after the section, if you interested to know more about MACD or divergence, all this, you can drop your comments into our comment sections, or you can let me know then we will try to arrange one to share with you guys. Okay, basically MACD is a momentum indicator. It tells us the momentum and also the trend. Okay, so what we are seeing right over here is this is the telco. Okay, since July, August, where do you guys see the trend going? It's going down, right? It's very obvious it's going down. You can see the blue line is also heading downwards. Okay, but if you look at the divergence, the MACD, you can see despite that the price is forming a lower low right over here. You can see the low and then it continues to form another low. The MACD is forming a higher low instead. So that is telling us that the selling momentum on telco actually has slowed down. The selling momentum has slowed down already with the divergence. Okay, of course, does it mean that once divergence come out, then we all in, hood, buy? No, okay, so there could be two outcomes after we see divergence. One is the market could move sideways. One is it could be really the bottom and start trading higher. So for us to be firm that this is a bottom, how we can do is we can look for the price to stay above the 20 days moving average. 20 days moving average is telling us that this is the price of the average price for the past 20 days. So if it stays above the 20 days moving average and continue to try to go higher, it's telling you that right now everyone in the market, they are willing to pay higher than the price that for the past 20 days, for the past 1 month, everyone has been buying. Means people are more convinced, they have more confidence in these stocks. There must be something in the water, right? That's why people are willing to pay more to buy the stocks right now compared to those who have been buying at a lower price for the past 1 month. That's why when the price is above the 20 days moving average, it's telling us that the confidence level are there. People are buying it. It's going into an uptrend. And you can be one to chase, to wait people to tell you, hey, Ali, this stock's very good, and the price has removed up here. Or you can look at the charts, look for the divergence. As long as it started to stay above the 20 days moving average, you start to go in and buy. You can choose which type of traders or investor you would want to be. Okay, but what we are seeing is telco is forming a divergence, and there is a slowing down in the momentum. Okay, but of course, if we are continue to see another strong selling down, and the MACD start to point lower, then it's come in line as well. Come back in line already, and the selling momentum could continue. Okay. Similarly, on consumer products index, we are also seeing a divergence. Okay, you can see that it has been going on downtrends. Okay, and very different from telco is the breakout of the trend line has returned back under the trend line already. Okay, so it's telling us that the rebound in the consumer product has been weaker compared to the telco, even though the selling momentum both have slowed down. Okay, so similarly, what it needs is the consumer index has to be above of the 20 days moving average. Okay, above the 20 days moving average and continue to break higher so that we can see the development into an uptrend. Okay, so from that, it will be safer and better to call it as a bottom. Okay, for all these laggard sectors. Okay, the next one will be on the energy. Yeah, so if you look at energy is a good one, okay, whereby we can see it's also on a downtrend, okay, also on a divergence, but you can see it has moved up above the 20 days moving average. You can see it tried to sell down, but it cannot drop below the 20 days moving average, and it continued to trade higher from there. Okay, you can see it just touch the 20 days moving average and start to trade higher. So for whoever that's able to catch this over here, some of the stocks that rallied on this breakouts, they are like Dayang, rallied on Monday, I believe. Okay, but it came down already today. with all the sectors are in red today. Okay, but Dayang has been moving up with the breakouts, and quite a few of the oil and gas sector counters as well. I believe key field also have been moving up very strongly with the bottoming and rebounding. Okay, so these are the tricks that we are using, reading the strength of the index, and then start to look for some of the good potential counters in that sector, filter it out, and focus on those to pick up and trade. Okay. Last but not least, will be on the technology with a potential bottoming. We are seeing, you can see it's on the downtrend. It has been trading higher and then continue to go higher from there. Okay, so that happened in somewhere around like bottoming happened in November to December. It started to stay above the 20 days moving average line in December. And that's one of the things that we spotted and traded on some of the technology counters in December as well. Okay, so technology is potential bottoming and it could continue to trade higher from there with potential targets towards this area at 77 levels for technology index. Okay. Yep. So overall in the overview of the whole global equities, commodities, and currency, I'm just gonna do it like real quick. Okay. Since just now Victor also have shared quite a bit about it already. Okay, so what we are seeing on the US side on the S&P index is instead of trading higher on an uptrend, you can see it has been holding well along with the 20 days moving average and trading higher. Right now we are seeing the 20 days moving average line is at this phase whereby it is choppy and there stands a potential of coming down or even or sideways for a further timelines. Okay, so for US S&P 500 is more towards a sideways, and similarly on Nasdaq wise, Nasdaq is tech stocks index for US is also very flattish at this moment. You can see the price is trading up and down of the 20 days moving average. So it's a turn of the rally since August, and it could be a retracement from there coming near to the 200 days moving average. So at this point for S&P and Nasdaq, the downside is actually stronger compared to continue to go higher with the flattish movement. Okay, how about our local Bursa Malaysia? Okay, if we look at our local blue chips index FVM wise, we can see currently our FVM is actually trading on a rebound from the retracements. Okay, so you can see from August we had a very strong rebound from 1540 levels, and we have been holding well around 1600 levels. Okay, which is the 200 days moving average lines, and also the key support resistance line at 1640. Okay, given that today we again had another sell down to 1600 levels, so this is a strong this is a short-term high that we are making, which come in line with this resistance over here. Okay, so if we are not seeing 1590 to 1600, this low area being supported, then very good chances that we might see further downward movement towards 1580 or even 1540 levels. Okay, so this at this point 1590 to 1600 supports for our FVM is very crucial because it is a major support of the 200 days moving average. It's the average for last year. Okay, and also it is the key support line for all the charties. Okay, so if this break lower, then it telling us that it is a cross below 200 days moving average, which it never happened for the last year. Okay, if it's crossed below the 200 days moving average, it's telling us a bearish signal, and we might see further selling down. Okay, as for our small cap wise, actually small cap is stronger compared to the FEM index, KLCI index, whereby we are seeing it form a bottom and then has breakout from the bottom. So as long it holds above 17,700 levels, we should see further this bottoming continue to remain solid and might continue to keep the small cap to trade higher from there. Okay. And some updates on the commodities, like COMEX Gold is on the flattish right over here right now. Nothing too fancy about it. And next we will have the crude oil, where oil side will be a little bit more interesting, whereby we are seeing a potential bottoming. You can see it comes to 16.8 levels. It has been forming the bottoming and has been bouncing off, and a very good chances that it might come back to $17.7 for this US oil. WTI is US oil. Okay, and for the breakout, it might continue to go to above $80. So if that happens, that could come in lines with to attract some of the trading interest into some of the energy stocks that we are seeing to be the laggards for that we shared just now. Okay, so oil price is something, US oil price or the Brent oil is the prices is something that we might want to focus and monitor closely to look for any trading opportunity for these 2 months. Okay, as for FCPO, unfortunately FCPO right now is a form of double top over there. You can see it's like a M and then coming down. So with the double top, it broke below the neckline of 40,570 levels, and then the chances is it might continue to trade lower with a double top target somewhere around 4,100 levels. Okay, so for this short-term period, the CPO is more towards a bearish view, and plantation counter could be remain weak lah. So what does it mean? It means everyone got a better chance to buy cheap lah for HS Plan, Jayatiasa that Chu Hong was recommending. You want to buy when the stock price is cheap or expensive or high? Cheap, right? So what we need to do is just look at the FCPO price whenever it comes to near to a 200 days moving average or even near to 4,100 levels. That could be a support, and you can start to scout for all these plantation counters that you like and then start buying some of them already. Since you're buying for them to be undervalued, right? You're buying for some of good dividends also, right? Then why you want to buy when everyone is chasing and buying? Why don't you bargain hunting and then buy it when it is cheap, since you believe into their value? Okay, yep. So for the outlook for FCPO wise, it's more towards downwards, and the technical outlook is weak at this moment. Okay, and for the USD, for the ringgit, okay, we know that since end of September, our ringgit has been further weakened. Okay, but from the chart right over here, we are seeing divergence, which means that the ringgit could be come to a bottom. Okay, come to a bottom, and we might see some recovery. Okay, so for those who have been trading on export counters, taking advantage of a stronger dollars, weaker ringgit, all this, you might want to be really cautious and careful. Okay, whereby if the ringgit is strengthened, USD is weaker, then some of the trading sentiment, it might change for a short-term period. Okay, so finally, trading ideas. Okay, all right. So this is the part that I have been thinking for a lot, and when today I was driving here, I was like, wow, these 2 days dropped 30 points already. Yeah? Should I just leave my trading ideas blank? Hey, everyone, don't buy. Okay, but how many of you, after seeing that the market dropped more than 30 points, how many of you thinking of buying actually? Any of you thinking of buying? No. Then we can skip this part since no one interested in buying. Okay, actually when I was coming, I actually do not learn from me. I was driving alone. Okay, and it was actually quite dangerous because my wife actually told me, hey, okay, the stock, this stock, that stock A, stock B has dropped to this price and that price, complaining about his portfolio. I was like, thank good lah. It's time to buy more. since it's cheaper, since we believe into the fundamental value of it. So that's why my one hand is driving, my one hand is, wow, which price should I key? Set the GTD some more. No, I cannot set the GTD. Not enough hand to set the GTD. All day order, trying to get some. Okay? At cheap. Okay, so the trading ideas, this round I'm going to share with you guys with this new thing that I'm introducing, which is the seasonality. Okay, so this seasonality of is something that I've been sharing with my audience every month. Okay, I have this monthly traders talk on the first Monday of every month on our YouTube and Facebook. Okay, so the first row is the performance, the historical performance for all this index and sector for the past. Index-wise is 20 years average. Industry-wise is 5 years. For the past 5 years and past 20 years, what is their average performance? Okay, so you can see that. You can see for the first 3 months, first quarter of the year. For past 5 years average, you can see, do you guys see more red or more green? For those that not more than 0.5%, I just leave it black. But more than 0.5%, I will just mark it accordingly. Do you guys feel that it's more red or more green? More red, I also feel like more red, okay? But if we look closely, okay, we can see that in February, okay, in February, the second row is February. In February, almost all of them, they are in green in February, except for technology and also healthcare. Okay, so right now you can quietly buy in January. So when February, when the share price up, then you sell to all those that chase. It's time to buy cheaper. Okay, but if we look at January-wise, those that more performing in January, it will be the small cap, energy, which come in line with the US oil. The oil price is bottoming, and also the energy index is also breaking out from the trend line. Okay, and also the technology, the bottoming formation in the technology index as well. So these two are the sectors that you might want to look at it. And February one is good month to go in, but when it comes to March, we are seeing more profit taking in March. Okay, March, most of them they are in red. Okay, so this could be the idea and also the strategy for you guys. Look for the chance to buy in January, buy more in February and take some profits, and also when it comes to March, sell more and look for the chance to what? To check with Alki again whether April will go up or down. Then also to decide whether to buy or not. Okay. Okay. So as for the catalyst wise, I will be looking for this quarter. I will be looking at these few sectors. Okay. For global side, the export oriental. Okay. So we are expecting dollars could remain strong. So at this point, although we are seeing that MYR is forming a divergence, there could be some rebound in the ringgit, which lead to some of the export-oriented counters to come lower. But I will see that could be a chance to buy it since we are expecting dollars to remain strong with Donald Trump to come into the picture. Okay, and with that, technology glove counters, they are export-oriented counters. And these are the two sectors that I might to look into, and also materials as well. Materials includes some energy related palm oil plantations, all this. Not the steel side. Okay, with the US tariff and also the AI chips, all this ongoing. As for local sites, I will be more focused on the telco with the potential deployment of the second 5G, and also of course with the construction as well. As for energy, energy has been quiet with the dispute between the Petronas and Petros. Okay, they have been talking about the reduce of the from the capex from the Petronas, so that's why people has cutting down the expectation and valuation for the energy stocks. But Petros is kind of like commits, try to commit with a 40B capex commitment over the 5 years, and that kind of like offset a little bit. So we might see some recovery in energy sites. Okay, so that brings to 4 stocks that will be looking very closely for this quarter. The very first one will be UWC. Okay, so for UWC wise, you can see UWC is trading on an uptrend. So, okay, it's a semiconductor companies, and their sales has been recovering since October. They have been calling a bottoming in their semiconductor sales in October, and what market also they are seeing is a potential upcycle for UWC. Okay, if you UWC also, I believe they are also managed to acquire a new front end semiconductor services. Okay, so products also with the technical outlook wise, it seems quite convincing with the UWC to trade along with the 30 days moving average, and I will be looking at it with the recent weakness in the market, in the sentiment. As long it come back to this area at 2 ringgit 60 cent or 2 ringgit 74 cents, these are the area that I will be quite comfortable to get some of the get some position in, okay, at somewhere around 2 ringgit 74 cents. Okay, that could be a key support levels for UWC, okay, rather than chasing high right now. Okay, so for those who are trading in line with the 20 days moving average, then currently at 2 ringgit 97 cents, 3 ringgit, it is touching the 20 days moving average line. So anytime it bounces from there, you might want to initiate a small position for the trend continuations. Okay. All right. Sorry. Yeah, sure. 20 days moving average, the blue line. The red line is 200 days. The red line is 200 days. The blue line is 20 days moving average. Okay, so what I'm seeing at 2 ringgit 74 cents, this area, 2 ringgit 67 to 2 ringgit 74 cents, this range is a key support range for UWC. It's also near the 200 days at 2 ringgit 80 cents. So it's about that, the level over that region, somewhere near to 2 ringgit 70 cents. Sorry? At this point, MACD wouldn't have any entry until the line is flattish and then start crossing above. But from MACD wise, we can see that MACD is above the 0 levels, which telling us that momentum remains at the positive area, but it's coming down because of the retracement. So if you're using MACD, then you will be waiting for the price to flattish a bit, and the cross up to go in and buy. You mean here? You mean the crossover? Okay, so if you are looking at the technical chart wise, okay, at this point with the crossover, we are seeing at a pretty much the same level, 180 cents, a double bottom rebound. Okay, and this rebound is a significant one with a strong spike rebounds. Okay, so if we combine the candles together, so this will be 3 candles. We combine these 3 candles together. This will be a red candle, and then this will be a green candle. So from here, with combining the candles wise, we will have a bullish engulfing right over there, which telling us it is a strong bullish reversal signal at the key level of the double bottom. And couple it with the MACD crossover, that would be telling us that this is a bottom, and then the price is trading higher from there. But of course, all these are said on the high side. Okay, so if one who is trading on double bottom, and you have read the news, actually during October there are some research report coming out. I think it's from Philly Capital. They were sharing that their semiconductor sales is expected to improve during that time. Okay, so if you couple with all this, that will be a very good buy at that time with this double bottom rebound. Okay, the W shape, yeah. Okay, but of course, right now it has rebounded. Thing has passed. We cannot go back all the way back to November to buy them. But we are seeing the result has been improving. The sales has been improving. Okay, and we are also might see an upcycle in the semiconductor. The sales could has been improving for the past few months. Okay, based on the SIA, so we could see that the company to continue to deliver a better performance and along with the uptrends. Okay, so for those who trading with the moving average, you might don't want to buy when it comes to this level. This is just close eyes and buy, but you might want to wait until again it trade above the 20 days moving average and hold above the 20 days moving average and continue to trade higher. Then this is the point that you can just buy and you do not need to struggle any. Okay, yeah. Otherwise, if you are just close eye and buy, then you have to struggle whether it will rebound higher or not, or it might stop for a while. Okay, so for UWC, the Bloomberg consensus is somewhere around at 3 ringgit 40 cents, with 4 out of 6 they are calling for a buy. Okay, yeah. So the strategy will be accumulations at 2 ringgit 67 to 2 ringgit 74 cents, with the target at 3 ringgit 48 and 4 ringgit 20 cents technical targets, and also the stop at below 2 ringgit 49 cents for this UWC. Okay, yeah. The next one will be an oil and gas counter, Dayang. Okay, so very similar to what we see on the energy index. Dayang also perform a divergence, and then it hits the support and start rebounding back towards the 20 days moving average. And with such rebound, it actually has touched 200 days moving average and resist and came lower. Okay, so as long as the price able to stay above the 200 days moving average and start to bounce from there, I would believe that Dayang is a good buy for this quarter. Okay, so the why is it so is Dayang from the Bloomberg side, we have 3 ringgit 40 cents Bloomberg consensus TP. Okay, with 8 out of 11 they are calling buy. Okay, and they are also one of the catalysts is they also view that this counter is undervalued, with some of those they are excessively discounted with their profit projections. Okay, yeah. So for the trend wise, we are seeing that is potentially turning into an uptrend. And strategy actually today is it closed at below 2 ringgit 10 cents, which is it can give us a first entry, with the second entry at somewhere around near to 2 ringgit levels. Okay, from there we are seeing a potential bounce from that, bounce from support levels towards the 2 ringgit 50 cents area, or even if the trend is strong, the oil price also come along to trade higher, then we might even see higher for Dayang at 2 ringgit 86 cents area. Okay, the stop wise is slightly lower at 1 ringgit 95 cents. The third one is Anju. Anju is steel related counter. It's a steel counter. Okay, so for Anju wise, what we are seeing on Anju is Anju is one counter that is not going on uptrend out of the four counters that I have put up today. It also counters that I would see that the risk is slightly higher, whereby the steel sector, steel industry remains soft at this moment, with a slow Chinese economy performance. Okay, yeah. But based on the technical part, we can see that as the Anju is trading at the bottom at this support area between 80 cents and 94 cents, we can see the volume, they are actually not to say quiet, but we are seeing active volume happening. Okay, this is actually a signal of accumulation. Some of those that seeing that the price could be cheap and it's attractive for them to buy and collect. Okay, so Anju is one counter that I see that's quite interesting, and then good to look at it for a potential bottoming for this quarter. Okay, and one of the catalysts is if you read through some of the an article about Penang LT. Okay, I think it's released over the weekend. Okay, it's actually also sharing that Anju is well positioned for a potential steel demand from Penang LRT that's gonna be launched soon, okay, in this year, okay. But of course, however, the risk over here is their losses is mounting and increasing, okay, and also the weaker steel price. Okay, strategy wise is to reduce the risk out of all this unfavorable risk aspect. You might want to collect it at a lower price at 80 to 85 cents, so that your stop loss will be minimal. So if it's really wrong, then you don't suffer a lot. But if really right and it become a bottom and coming out, your return will be much greater. It will give you a very good reward and risk and reward ratio payout for this NGU. Okay, the Bloomberg consensus TP is at 90 cents. Last but not least will be Persist. This is solar related counter. Okay, why I choose Persist over here today is one thing is we have been seeing market talking about LSS5, and LSS5 is the biggest I should say amount that's been given out compared to LS3, 4, or this, okay, and government is start to distributing in this year, okay, and Persist is solar related counters, and we are also seeing that with the release, Persist start to break out from this so-called sideway movement, or some of those they might say is a pennant. Okay, but generally it's a sideway breaking out from there and started to trend higher. Okay, you can see the price has been started to hold well above the 20 days moving average, and as long it come near to the 20 days moving average, start bouncing off. You can see like this, start bouncing off. Then the trend it could remain and trade higher from there. Okay, so for Persist, Bloomberg consensus TP is somewhere around at 1.21 ringgit. That's another 15%, 15 cents up from today's closing at 1.05 ringgit, I think. Okay, with the catalyst of rising renewable energy demands, and also the LSS5 as mentioned, with the technical target also somewhere around at 1.20 ringgit, or even if the trend sentiment is good, strong, then we might see 1.35 ringgit. All right, so that will be the four technical pick that I'm sharing with you guys for this quarter, for first quarter of 2025. All right, okay. So if you guys, we won't be here for every quarter, unfortunately. Okay, for every quarter, actually, we having it online, and every month my team is also having a monthly traders talk to share about the monthly outlook. What are things that we look for the months? Okay. So in order to have all this, you can feel free to scan the QR code right over here and follow us on our Facebook and also on our YouTube as well. At our social media side, we also share a lot of daily info and some of the market updates as well. All right. Okay. So any questions from the floor? Yeah. Can. You can. You have 20 also can. All right. Okay. Yes. Okay, Farm Fresh and Volatility. Yes. Can we have the Farm Fresh charts? Okay, so Farm Fresh actually was the peak last year on the second quarter, 2024. Okay. Okay, we have to bear in mind with the FFB Farm Fresh. Oh, okay. Never mind. I have my phone over here. Okay. Okay, if we look into FFB wise, okay. Do you need any indicator? What indicator that you need? We can put it up. Never mind. I no, actually I can just read without any indicator. Do you need any indicator? Okay. How about we put 20 days since we have been talking about 20 days? Okay. Can we put the 20 days moving average? So this is the trading view that you guys can use. And my handsome colleague right over here, Dexter, will share with you guys how to exponential. Okay. Why exponential is because moving average, the exponential is it weighted more on the recent data compared to equally weighted throughout the data. So it will be slightly faster. Yeah, exponential because it weighted on the more on the recent data. The recent data will have slightly higher weightage. Oh, okay, then too bad lah. Never mind. We just go through it. Okay, can you zoom out? 缩小。没有，那个这个放下。这个press 这个 sorry 可以，然后缩小它。你这样子收不到。Okay, never mind. Okay, so from here, what we are seeing on the FFB Farm Fresh points, what we are seeing is Farm Fresh actually at this moment, okay, since August, it has been rally from 1.40 ringgit to 1.90 ringgit. So generally, psychological level for the traders, for investor is the first target is 2 ringgit lah. So that's why you can see it comes near to 2 ringgit. Very automatically, there are some profit taking to come in. And at this point for Farm Fresh White, it's just merely on a sideway. Okay, a sideway between 1.75 ringgit to 1.90 ringgit. And the support is quite okay over there in the sense whereby it not every time it touched 1.75 ringgit. Whenever it comes to slightly below 1.80 ringgit, then they are buying support to come in and buy it up. Okay, and Farm Fresh is stocks you should see more instant players, funds buying into these counters. Is not retail, really fully retail kind of trading counters. So that's why we can see that for those who are buying at 1.80 ringgit all this thing, it could be some fund managers, funds who are still thinking that Farm Fresh could be remain cheap. Okay, so as long as it establish the value around here 1.80 ringgit to 1.90 ringgit, if it one day suddenly break out of 1.90 ringgit, then there will be some technical traders to come in and chase and buy, or even that might push above 2 ringgit levels. Okay, yeah. So at this point, if you want to trade ranging, then you can buy somewhere around 1.75 ringgit to 1.80 ringgit and sell at 1.90 ringgit. Okay, if you don't want to be stuck your money in, then you might want to just monitor it until it have new catalyst or even breakout. Then only you just jump in and ride. Otherwise, if you're looking for bargain, anytime when market is bearish or selling very strongly, then 1.65 ringgit level, this is a good number to look at it for a potential retracement touch and bounce. Okay, at 1.65 ringgit. Okay, and the next one is Volatility. Volatility is a oil and gas related counter, but Volatility, it has the number of share issues is very big. That's why it's not easy to trade Volatility. Okay, so you can see the movement in Volatility is not very much in line with what we are seeing on the energy index. Okay, so one of the reason is because is this. Despite that, I see many, I think a lot of buy call on Volatility, right? By quite a number of research analysts on Volatility, but the share price not really moving up very much for Volatility. This is a counter that I will be really careful to trade because at this point, technical view wise, it's a downtrend. Okay, it's a downtrend. I'm not seeing. The volume is little. We can see that the selling momentum for Volatility should be slowing down already near somewhere around here. Okay, given that the volume has getting thinner. Okay, but At this point, unlike just now is Anju, I don't see any accumulations for Velasto. Okay, yeah. Oh, okay, not for Velasto. Okay, so Velasto, if you are really interested to buy and hold, this could be near to a potential short-term bottoming price, near to the bottoming price. Okay, and if oil price really rebound and go strongly, that could lift the whole energy index, and Velasto could be benefited from it. Okay, but for midterm movement wise, we are yet to see Velasto to go into any strong uptrend at this moment. It's more towards remain at the downside and remain weak. Okay, for the timing wise, it might have to go sideways for a little bit more time before it can go higher. Okay, any other? Yeah. Or Supermax. Okay, we look at Top Glove. Okay. So, like just now, what we mentioned, glove counters has been weak. Okay, it has been rallying. If we look at in September, it has been rallying from 90 cents all the way to 1 ringgit 40 cents. That's more than 50% upward move already from this movement over here, from 90 cent gap up, and then from here it has been moving up. Okay, so for me, this is pullback retracement. Okay, a profit taking after it has been moving up. And if you open up right over here, okay, it's actually very obvious that this is a potential top for Top Glove. I think I just mentioned it on this Monday, right, on 6th. I also, because Monday I just had my monthly traders talk, and Top Glove and Hata was mentioned in my last month monthly traders talk, so I update them. Okay, so Monday I was telling I think it's on the YouTube. You can also go back and play back if you want to know more. Okay, but we can see from Top Glove is this is a dark cloud cover. This is a bearish engulfing. This is a shooting star. So you can see all these are telling you that it's a bearish signal, bearish reversal signal. Whenever everyone push up the share price, people can't wait to sell and take profits. Every time the share price is up, there will be seller trying to sell it down. People are taking profits. So that's why on Monday, today is Thursday, which is right over here. On Monday, I still remember on Monday morning, all the glove counters suddenly spiked up because I think on the HPMT, Chinese has reported a very active cases on HPMT, and that suddenly attracts some of the buying interest into glove related stocks. Okay, yeah. But despite that, it has shoot up to 1 ringgit 40, above 1 ringgit 40 cents. Profit taking came in. People don't really care too much about the HPMT because they felt that the the glove counters at this point it could be a little bit too expensive. And if we look into some of the Bloomberg consensus, many of all these glove stocks, they are above the average TP price already. Okay, so I will say that generally what happened right over here is profit taking, and then we are seeing a normal retracement. Okay, okay, so sorry.
Let's say we want to buy this stock. Is there a future for this stock, for this business? If there is a future, maybe another 1 2 months, we may pick up.
Yeah. Okay.
What is the best point
to go in and buy? Okay, so your name is Mr. Tan. Okay, so Mr. Tan is asking if one is very confident and with the fundamental of these stocks, you think it is a buy, the fundamental will continue to keep the business there, the business will boom. Okay, so where is the good entry for Top Glove? Okay, so for Top Glove, why you can see Okay, for top glove wise, you can see right over here. You can see every time with this, you can see it's very obvious. It's also the same pattern. It push up profit taking, push up profit, push up profit taking, and the selling down. Okay, so whenever on the selling down, you can see it will come to the previous high level, and this is the level that it might stay over there, get supported. Okay, so for top glove wise, if we are looking at the price for top glove, okay, sorry, the chart has to reload again. Okay, for top glove wise, if we are looking at the chart of it, the level that we are talking, the similar level that we are looking at it, it could be somewhere around.
So first of all, the business still okay lah.
Sorry,
Most important.
I think yesterday. I think yesterday, Top Glove just released. They are talking about increasing demand and also improving sales. From Top Glove yesterday, there is an article on the Edge, and also with the tariff. If we are seeing a higher tariff imposed on the Chinese glove, that could help their business as well because it reduce the competitiveness from the Chinese glove. Yeah, yeah. Okay, so if we look at it very similarly with the selling down, it could be hover somewhere around this area, which is the previous zones, which is somewhere around 1 ringgit 10 cents to 1 ringgit 20 cents. Okay, area. Okay, so psychologically, the support level it will be at 1 ringgit. So if you really want a very cheap price, then you look for 1 ringgit. But as long as it comes somewhere around 1 ringgit 10 cents level, I would say that we should see some support to come in ready at 1 ringgit 10 cents to 1 ringgit 20 cents level. This should be the support level for top glove. We should see the sell now to slow down around this area, and then anytime bounce from there, you can look to pick up some for short-term trading.
Theory or something. MACD 20 and 200. And see the divergence.
For the divergence, can you put in MACD? I'm not sure if there's okay. You try to put in MACD. Yeah, because this is a free account, so we cannot put in any indicator. Yeah. Okay, very sorry about that. So we will try to have a class about MACD. So if you're interested, you can join for the class for MACD. I will try to arrange one for this year online. Then from there we can talk more and have more examples on the MACD divergence. Indicate where is the high and where is the low. Yes. Yep. That is one trick that I've been using MACD divergence to determine the potential peak and also the bottom. Okay. Yep. Any other questions from the floor or online? Is there any? If there's none, then yeah, sure.
Oh, share market. What about how you look at cryptocurrency now?
Cryptocurrency.
The risk factor is right, but the profit market is also
Okay, for cryptocurrency, I will believe that everyone we seen that cryptocurrency has been rallying from 60 something thousand to from 70,000 like that all the way to 100, and I think highest is 108,000, right? 108, 109. Okay, for Bitcoin for Bitcoin. Okay, so I would believe that since the peak of 60,000 right now is at 100,000 something. Okay, is there any other thing that can continue to drive crypto to trade higher besides technical? If we look into weekly chart, all these things technically wise, we don't need to look at the chart, but it's likely to be overextended since the rebound from 60,000 levels. Okay, if we look at the bigger chart wise, it's even overextended. Okay, so whether the Bitcoin, it can continue to go higher or lower. Okay, for this one, we cannot rely on the technical. Okay, it's not easy to trade Bitcoin using technical. You have to rely on especially for Bitcoin, for this kind of massive movement, we have to monitor very closely on Trump's tone towards the cryptocurrency. whether what is the government policies towards it. Are they setting it as any like previously we were talking about asking the Feds to look into cryptocurrency as the safe assets or reserve, all this thing. So any of all this talking and policies that come out from Trump involved with cryptocurrency, and if it's bullish, then that could drive up the price. Okay, yep. Okay, so that are some of the hints and type of news that we want to look at if you are trading on the Bitcoin and other cryptocurrency. Okay, any other questions? If not, thank you very much for coming, and thank you for your time, and we shall see you online in April. Thank you.